Welcome to our Fast 5 series. Every month we will touch upon 5 key questions which are on top of investors' minds. In this inaugural episode, we are privileged to have with us Anup Maheshwari, co-founder and CIO, IIFL Asset Management. Hi Anup, great to see you. Thank you for taking time to speak with us.
Always a pleasure.
So let's get started.
Sure.
Let's begin with a macro question. Oil prices have been a big subject of discussion of late. How do you see this impacting inflation and broader markets?
So rising oil is obviously bad for India and for the Indian economy. Just one broad rule of thumb to remember when you're thinking about oil is that a $10 per barrel increase in price of oil adds to 50 basis points of inflation, 40 basis points impact on the current account deficit, and 30 basis points impact on the fiscal deficit. So obviously rising oil is not good for India, but thankfully we seem to have settled in a bit of a range now, so it doesn't seem to be as much of a pressure point right now.
Thanks. So which are the sectors you are optimistic about?
So when we think about sectors from a long-term point of view, I'd have to say financials and IT are two sectors that matter a lot to India, and I'll tell you why. If you look at the wage bill of the financials and IT sector, the total salaries paid, they make up 50% of corporate India's total salary wage bill, just these two sectors alone. So how they perform matters a lot from an overall consumption standpoint and a growth standpoint. The good news is longer term, both these sectors are in very good shape and continue to have a lot of scalable opportunities. So financials and IT will always be core to any portfolio. More near term, I would say, just given the environment that we're in, some of the more defensive areas like pharma, consumer staples probably also make more relevance to the portfolio.
Yeah, we understand you follow several processes to analyze companies. Could you throw some light on one key area?
Sure, like you mentioned, there are many processes, but maybe I can just touch upon forensics. You may have heard the term. So forensics is where you're trying to look into the accounts with a bit of a microscope to see if there's anything that you can spot there that is not in order. So we follow 9 forensic parameters that we rank companies on. Just to give you a sense on what some of them are. So for instance, one of the first starting point is something called operating cash flow to EBITDA ratio, which is nothing but how much of your profits are actually getting converted into real cash. That tends to give you a good idea of the actual strength of the business, or are numbers just being reported without actual cash being produced. Another interesting ratio we look at is capital work in progress to gross block, which is nothing but how much of investment is going relative to the existing infrastructure or fixed assets that are already in the firm. We look at this ratio because if companies have very high capital work in progress all the time, it could be a way for them to actually take some money out of the business. So you need to watch out for that. A third parameter is something called cash yield, for instance, which just looks at the interest earning on the cash in the books. You may recall Satyam was a big governance issue, and one of the main reasons was the cash yield number didn't add up. So at that point in time, perhaps people weren't looking at it as closely, but that's another important parameter for forensics now, just to give you a few.
Yeah, thanks. So what do you feel about market valuations now?
So market valuations, when we think about market valuations, we normally express it in the form of something called price to book ratios. So very broadly, the market, if you look at the last 15 years or so, has been trading somewhere between 2 to 4 times price to book. That's the extreme ranges of the market. Whenever the market comes down to 2 times price to book, it's a great time to invest. Whenever the market comes close to 4 times price to book, you have to be very cautious. For the most part of the market's lifetime, it generally on average tends to trade around 3 times price to book. As we stand here today, the market valuation is at about 3.25 times price to book. So it's a bit above average. So therefore, we're saying the risk reward is to that extent a little out of favor for the investor. So it's not at the extreme end yet, but it is slightly higher than what it should ideally be. But having said that, we have to keep picking and choosing companies in the portfolio bottom up. So that's really our main focus. The market's slightly expensive, but not intolerable.
So in an expensive market, what would be your advice to investors?
Well, at times like these, when the market's trading a little above its average valuation, you would tend to continue with the concept of systematic investment that you're doing into the market rather than any big lump sum investing, just to be able to participate in case there's a bit of a downturn as market valuations normalize. So we'd say continue with SIPs. I mean, we've seen the power of SIPs over a number of years by now. So continue with that process of investing. And if the markets come closer to the lower end of the range that we mentioned earlier, for whatever reason, that's a great time to probably accelerate the SIPs or make a lump sum investment at that point.
That's it for now. Thanks, Anup, for this fast-fire, insightful discussion. We look forward to hosting you again.
Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.